Hi, today we are going to cover chapter 7, which is about cash flow analysis. Okay, so before we get into the detail of the chapter, I'd like to give you some informations, or I would like actually to start with some specific informations about cash flows. Okay, so net cash flows equal cash outflows minus cash inflows. Okay, so any cash entered the company during the specific period of time, or any cash went out from the firm during a specific period of time. So what does we mean by cash outflows? Are they a kind of expenses? Are cash outflows expenses? The answer is no. They are not expenses. If they are expenses, their expenses are given in the net income statements. So why we are repeating them? Okay. And what about cash inflows? Are cash inflows revenues or earnings? The answer is no. They are not earnings. They are not revenues for the company. So they measure, actually, cash flows, statement of cash flow measures the cash from investing and financing and operating activities. Okay, so the cash flow statements measures cash from investing, financing, and operating activities. So cash flow from operations, like this. Okay. So what are the usefulness of cash flow statements? Actually, the usefulness is through these statements we understand statement of cash flows. We can understand and analyze the company's ability, the firm's ability to meet its obligations to pay dividend. To raise funds, to borrow monies. So we understand the capability, the ability of the company, whether they can pay back the debts, the financial obligations, whether they are capable to pay dividends or raise fund and etc. Okay. And let me minimize this one as well. Okay, so we know that cash is the most liquid asset of the company. Among the current assets, liquid assets, cash is the most liquid one. Having too much of it will harm the company. Having less than enough also harms the company. So for the purpose of the company, it will be measured like beginning of cash at the beginning of a period versus at the end of cash. Okay, during that cycle we will measure the cash, the existence of cash, and it will not be measured such as income by accruals. Okay, we have already mentioned that, like it will be measured by cash outflows and inflows. Okay, decreasing in cash and increasing in cash. So two different methods for that, for measuring or for preparing cash flow statements. And what is important here to know is cash provides both liquidity and flexibility. So what does we mean by liquidity? Liquidity is the ability of the firm to raise cash or equivalent for their emergency uses, for the emergency events. And flexibility is the ability to rise to finance unexpected events as well. Okay, so the usefulness are liquidity, solvency, and financial flexibility. How far this company is from bankruptcy. Okay, they are out of cash, the riskiness of the company will rise. Okay, so an analyst, while analyzing a cash flow statement of a company, may be looking for to answer of these questions or more similar questions. Okay, so how much cash is generated from or used in operations? What expenditures are made with cash from operations? How are dividends paid when confronting an operating losses? What is the source of cash for debt payments? How is the increase in investment financed? What is the source of cash for new plant assets? Why is cash lower when income increases? What is the use of cash received from new financing? So all these questions will be answered by an analyst, rational analyst actually, through investigating the cash flow statements. Okay, and these, as we said, for measuring, investing, operating, and financing activities. So the the purpose of cash flow statement is that. Okay, so each activity over here will be separately presented in the cash flow statement. Okay, like net cash outflow from operations plus net cash inflow from operations. So we separate the cash flows that has been used or generated from investing activity and financing activities. Okay, and as I said, these are not revenues and expenses. These are cash flows. So beyond revenue and expenses activities anyway, so there are some like operating, okay, cash resulting from related operating activities like extending to credit customers, investing in inventories, and obtaining credit from suppliers. So any activities in inventory, suppliers, and customers will be included in the operating activities. Sorry for the telephone ring anyway. So operating activities, okay, and also we have investing activities, which which include the cash that generated from the assets, actually long-lived assets and securities or PPEs, okay, property, plant, and equipment. So tangible assets, or let's say fixed assets. Okay, we covered that chapter already. Investing activities. So any cash that has been used for investing activities or generated from investing activities will be separately reported in the statement of cash flows. The same of financing activities as well. So borrowing, debts, issuing bonds, withdrawals, paying back the debts to the creditors, loans, and whatever. Any financing activity will be any cash that generated from financing activity or any cash that used in financing activities will be separately placed in the statement of cash flows. Okay, we will see that in example in the upcoming slides. So here are graphical representation of the different activities cash flows. Okay, so operating cash flows and net income of Dell company during these years. So as we see, net income is less than the cash flows. So the cash flow statement is, cash flows from the operations is way broader than net income. Includes many activities more than income. And during the whole years over here, we can see that operating cash flow is higher than net income. So So what about investing and financing cash flows of Dell? So as we see, this changes over time. For some years, financing cash flows is more than investing cash flows, but for some years like 2003 or 2004, investing cash flows is much higher than financing cash flows. Okay. So now, how we actually construct the cash flow statements? We have two methods to construct cash flow statements. We have indirect method, and in this indirect methods this method starts by net income. So at the top of the statement we will give net income, and then this will be followed by cash receipt, like cash inflows specifically from the customers, cash receipts from the customers. Okay, so that will be added as an inflow, and also cash paid. Okay, cash paid to suppliers, cash used for inventory purpose, cash paid to whoever, actually, like cash paid for rent, cash paid as a salary. So that's how it would be stated, this method. Okay, indirect method. But the direct, actually this one was direct method. No. Accruals yield cash flow from the operations. So that's correct. Now, my apologies for this, I'm mixing up over here. So this one is for direct method to be stated in this way. Okay, and then, but no need to mention net income. What about indirect method? Net income will be placed at the top of the statement, and then will be the other items will be expressed in this way: increase in this activity, this account, okay, decrease in this account, like this. But the most important thing to know is both indirect method and direct methods will end up with the same result, regardless the expression, the presentation, which is different, but that will be, the result is the same. Okay, both direct and indirect methods has the same result. Very important to always remember that. Okay, it is just different in the way of presenting these cash flows. So we are here now in the indirect method. So that's how it starts. Okay, net income, and then depreciation and amortization expense, but that will be positive. We add this. Okay, and then we have gains and losses, and then cash generated by current assets and liabilities. So net cash flows from operating activity, that will be the net cash flows from operating activities. Okay, so here is like depreciation and amortization expenses are non-cash expense. Okay, that's why we will add it back, as here has been deducted as a negative, but we will add this back to our statement. That's why the cash flow statement is larger than the net income. So we will, because of such an activities, okay, we will add this back. It's non-cash expense. That's why we will add it back to the operating cash flows from operating activities. Here is one example of cash flow statement. No. Am I missing something over here? No? That's good. So here is two examples. First one considered $100 sales, but no cash has been generated. All went to receivables. Okay, so at the end of the period, net cash flow from operations is 0. Okay, and why? Because we sold $100, but we didn't receive any cash. So a change in the operating cash flow is 0. Net cash flow from operations is 0. Having the other activities 0. Okay, only considering that one. Now, what if the collection? What if the receivable collected? Change in the receivables is $100. Like we collected. These signs are reversed. For example, this will be placed in the balance sheet as a positive, as we have more receivables. But here is negative. Okay, because we didn't receive it. It's a kind of cash outflow. We gave them, and the money is not in. But here is positive because it's considered to be cash inflow. Having no sales over here and keeping the other activity as 0, so when we collect the receivables $100, the net income, the net cash flows from operations will be 100. Okay, so staying in the preparation of the statement of cash flows, so the amount the activities would be presented or calculated in this way. Assets, cash outflow, cash inflow, okay? Liabilities, cash inflow, cash outflow. So assets, when we have cash outflow, the cash increases. The statement of cash flow increases. When we have cash inflow of the liabilities, that one will decrease. That's how we prepare the statement of cash flows over here. Let's get into an example over here. So here is the balance sheet of this company. Not easy to pronounce that one actually. Gold, I don't know. And here we have for the first year and the second year, and here is the net change in these accounts over here. So you know what will be the balance sheet, what will be included in the balance sheet. What about net income? Net income is here, and here, this is the income statement. In addition to these statements, there are some activities which is not mentioned over there. The company purchased a truck during the year for $30,000 and financed in full by the manufacturer. So they didn't borrow money to pay for this truck. They paid in cash. Okay. A truck with the cost of $10,000 and the net book value of $2,000 was sold during the year for $7,000, where no other sales of depreciable assets. There were no other sales of depreciable assets. So here is they sold an asset and they had a depreciation on it, and they raised some money. Dividend paid during year 2 is $51,000. Okay, so they paid dividends over here. Actually, this would go to the retained earning account. Okay, so steps in constructing the statements. Start with the net income. Okay, we start with the net income. Adjust net income for non-cash expenses and gains. Here, net income. So we have net income here. Non-cash expenses and gains. We start with those. Gains on sales assets minus $5,000. Depreciation and amortization expenses $35,000. So recognize cash inflows and outflows from change in the current assets and liabilities. So receivables are current assets. Inventories are current assets as well. Prepaid expenses, account payables are current assets as well. So accrued expenses are $4,000. We end up with the $113,000 over here. So that was the start. Okay, so I want to go step by step with this. Sum to yield net cash flows from operations. Net cash flows from operating activities. Purchase of equipment $70,000. Sales of equipment $7,000. Purchased, we paid, the cash went out, that's why we have negative sign over here. And sale, we have received money over here. Okay? And we end up with negative 63,000 from operating activities. Okay, and then change in the long-term assets yield net cash flows from investing activities. Net cash flows from investing activities. Mortgage payable for properties, real estate, preferred stocks, dividends went to investing activities. Okay? And that ends up to be minus 26,000. Change in long-term liabilities and equity accounts yield net cash flows from the financing activity. We have it here, as you see, and adding those, we end up with 26,000 actually over here. So what else? Change in the long run. Okay, we sum of the cash flows from operating, investing, financing activities to yield the net change in cash. Net increase in cash was 24,000. Okay, the beginning was 51. Add net change in cash to the beginning cash balance to yield ending cash. We add these two together, the increase in cash and beginning cash. So ending cash is 75,000. Just to remind you that cash is raised from 51,000 to 75,000. So that's what we obtain at the end of the calculation, cash. Okay? And the change was 24,000. The changes are given over here. Okay? And what about the direct method? So as we said already, this will be by expressing like an increase in this account and decrease in that account. Okay, adjustment for the accounts. Inflows and outflows methods. Reports gross, receipt, and cash disbursements related to operations, essentially adjusting each income statement item for accrual to cash basis. So whenever we have like each income item, for example inventory, for example not inventory actually, for example expenses, so we convert that expression of expenses to cash outflow. Okay, and just to know that this method is preferred to the indirect methods by the analysts and creditors. Very, very important to remember that. Okay. Now, so cash flows from, this is an example of the same company in terms of direct method of cash flow statement. So cash flows from operating activities, cash receipts from customers, cash paid for inventories, cash paid for operating expenses. We end up at 113,000. Let's check the indirect method. Net cash flows from operating activities here. 113,000. So identical results will be obtained. Okay. So here is the detail of the computation, which is summarized over here, expressed in terms of cash flow statement indirect method. So now we turn to the analysis, okay, of cash flow statements. Okay, what are the limitations of cash flow reporting? There are some limitations of the current reporting of cash flows. Okay, I'll go over this slide, read it because it has been well written actually. Practice does not require separate disclosure of cash flows pertaining to either extraordinary items or discontinued operations. We have been through extraordinary items and discontinued operations. These will be not reported in cash flow. We said like we should observe these activities while we are analyzing the income statement, but here in operating activities or in cash flow statements, no need to have a disclosure, okay, which is not good. Actually, it's a limitation. We should have such a disclosure that mentioning these extraordinary items and discontinued operations, any cash generated or lost because of these activities. Interest and dividends received and interest paid are classified as operating cash flows. So those could be, they are not from the operating activities, you know. Those could be separated actually. As I said, like this one should go, dividends should go for retained earnings, and this should go for liability in the balance sheet. Income taxes are classified as operating cash flows. So income taxes are not operating cash flows. Okay. Removal of pre-tax rather than after-tax gains or losses on sale of plant or investment from operating activity distorts our analysis of both operating and investing activities. So in this case, they have been misplaced actually, this activity. Okay. So implications of the cash flow analysis, as we said, like always, or in these given examples, operating cash flows are always less than net income. That could have been because of the limitations of cash flow statements. Okay, so interpreting cash flow statements would be in this way. This is an example over here. The items are placed here. This is just an example. We have no prior information, but it's given us it is. Sales will be represented in the net income or income statement in this way. Sales gains of sale of asset. But here, cash collection from customers. That's all. And it's less than this one. Cost of goods sold. Over here, payments to suppliers. You see, operating expenses, payments for expenses. Depreciation and amortization not mentioned here. Net income is 84. Cash from operations is 113,000. Okay, so regarding the interpreting of cash flow statements, it's important to know that an income statement reports the earnings and expenses, but those are not telling anything regarding the liquidity and solvency or financial flexibility of the company. So we don't understand the solvency and liquidity of the company by looking at the income statements. The same is cash flow statements giving broader view of operating activities, but they are not measuring profitability. So we don't understand the profitability of the company by looking at the cash flow statement. Okay, so cash flow statement is useful, but it's not a substitute of net income or net income statement. Okay, but it's important to know that a net measure, be in net income or cash flows from operations, is of limited usefulness. Okay, so both have the limitations. The key is information about components of these net measures. We should look at the components of these measurements over here. Okay. Another thing is cash flow from operations effectively serve as a check on the net income, but not substitute, as I said. So you can control the net income through cash flow from operations, but it's not a substitute. Okay, because cash flows from operations exclude some elements of the revenue and expenses, which are really affecting the cash position of the company. Okay, so our analysis of operations and profitability should not proceed without considering these elements. So we should care about those. We should care about those. So we go further in evaluating sources and uses of cash. The analyst should focus on the questions like below. Are assets replacements financed from internal or external funds? What are the financing sources of expansion and business acquisitions? Is the company dependent on external financing or internal financing, for example? What are the company's investing demands and opportunities? What are the requirements and types of financing? Are managerial financing such as dividend highly sensitive to cash flows or not? So these are particularly important for this purpose. So here is a clear picture of the cash flow statements. We can see here that most of the operating cash flow for this company anyway, most of this 56% of the cash flows are from operating cash flow. miscellaneous borrowing debts, okay, long-term borrowing and short-term borrowing. These are the cash, the sources of cash, okay, major sources of cash. So borrowing debt is 30%, from operations is 56%, and other assets are these. And we have the uses of asset. Okay, so we receive these assets from this part, and how those have been used over here. 16% for business activities, 8% for paying back the long-term debt, 13.5% to pay back short-term debt, 12% of these cash went to went to dividends, and also miscellaneous infrequent events, okay, 11% of these cash went to infrequent event, miscellaneous events. So inferences from analysis of cash flow includes like what we can expect, or what we can answer, what we are looking for while checking the cash flow analysis of cash flows. So management committed its resources, where it reduced investments over here. So we compare this by the previous ones, okay, previous periods, where the additional cash was derived from, where claims against the company were reduced, disposition of earnings and investment of discretionary cash flows, the size, composition, pattern and stability of operating cash flows. All these, okay, can be inferenced. I mean, we can expense, by looking at those cash flow statements, we can expect the next move of the company within this regard. So as we said, like, depreciation and amortization can be an issue for the cash flow statements. So here we have earning before interest, debt, tax, depreciation and amortization over here. So it's very important to know that depreciation and amortization, when we add it back positively, they are not adding cash, or they are not a kind of generation of cash for the company, okay? Rather than they are zeroed out of non-cash expenses from income statement, okay? We zero out them from an income statement. So that's particularly important to know, actually, how that works. So another factor that we cannot avoid is economic conditions, okay? The overall economic conditions of the country. So this might affect differently from a company to another one. Like, for example, the recent situation of coronavirus, like, dampened the economy of developed countries, US, UK, Germany, France, Spain, but any activity, any companies can be differently affected by these economic conditions in terms of cash position. Okay, so overall inflationary conditions, when inflation rises, add to the financial burdens of companies. So they will be financially much responsible, or the debts will get higher, simply saying. And the companies face challenges for analysis. Okay, whether these financial burdens is due to the operation of the company or they are because of the economic impacts of the country. Also, free cash flow is very important and to be calculated as this here. The formula is over here, which reflects the extra cash after all activities available for business or new investments, external investments. So those should be considered as well while analyzing the cash flow statements, cash position of the companies. So the statement of cash flow is useful in identifying misleading or erroneous operating results or expectations. So particularly it's important to clue on the below situations. That are given over here. Okay, so we have specialized cash flow ratios. We have some ratios over here to analyze cash flows. So cash flow adequacy ratio measures the company's ability to generate sufficient cash from operations to cover capital expenditures, investment in inventories, and cash dividends. So these are the main components, main activities of the company that need cash always. So this ratio gives us the percentage or the ratio or the information whether the company generates sufficient cash to cover these activities. Okay, and we have also cash reinvestment ratio, measure the percentage of the investment in asset representing operating cash retained and reinvested in the company for both replacing assets and growth in the operations. Okay, so that was the end of the lecture. I will focus on the practices in the next video and I will share it with you, so while solving those problems we understand what we were talking about. Thanks very much.